Hello, I'm Finola Burke from RaaS Research Group, and we're catching up today with Dimitri Courtelis, Group Chief Financial Officer for Ricergrowers, which trades as SunRice, ASX ticker SGLLV. Welcome back, Dimitri, and thank you for joining me.
Thanks, Finola. Good to see you again.
Now, you are looking at a repeatable result in FY25 to the very strong result of FY24. Can you take us through the key tailwinds and headwinds for the business as we sit here today?
Yeah, sure. So as we delivered to the market last week, revenue of 1.88 billion, which was a record revenue for the group, really underpinned by the strong brands that we've developed over a number of decades in the markets that we operate in. So from a tailwind perspective, we certainly are going to look to utilize that brand positioning, both locally and internationally, and really look to expand the product set that we take to market in terms of the depth of the product range, and then also looking at both existing markets and new markets that we look to expand into. So that's certainly been a positive, and we look to continue with that momentum into FY25 and beyond. Against that backdrop, of course, we've got the headwinds such as the inflationary environment that we're in, consumers trading down. So there's been a big push that we've seen to private label across a number of the product categories that we are competing against. And, so this inflationary environment with interest rates is certainly starting to look like it's feeling the pinch with consumers, and again, both locally and internationally as well. And a couple of other challenges like shipping constraints. The Red Sea blockage through the channel through the Suez Canal is still a challenge. So we've had to reroute a number of boxes around Africa. So it certainly takes a long time with those boxes on the water, and that extended time and costs obviously puts a bit of pressure on the net working capital position. And probably the other big one is the Indian non-basmati export ban that's still in place. So that's keeping long grain prices internationally at quite peaky prices. So combination of all of those is essentially the backdrop that we're navigating against. But we're remaining positive, and we've built some positive, as I mentioned, brand strength, and look to continue that to offset all of those challenges.
And SunRice shareholders received a considerable lift in dividend in FY24. And while it is a matter for the board to decide, is the quantum of ordinary dividend repeatable based on the guidance that you've given for FY25?
Yes, so the dividend is a record in itself at 60 cents. That was made up by a 55-cent ordinary and a 5-cent special. So hopefully, market can see through the split between those two. And in terms of your comments, so we obviously can't talk to forecasting dividends, but if I just refer us to the track record of what we've been able to deliver to date, the board's very cognizant in terms of rewarding B-class shareholders, and the dividend has been a significant signal in that space. And whether that's a combination of both the quantum and the payout ratio that the board considers. So, hopefully that track record continues, but the board is very mindful of rewarding our B class.
And with core debt now essentially paid down, what are your capital management priorities moving to FY25, Dimitri?
Yes, so the interest rate environment has obviously really made us pivot and think about where we're spending our core facilities. More so than we would ordinarily do. And with the current levels, we certainly focus on creating value for our shareholders with, improving our ROCE against our WACC rates. And certainly the pipeline of M&A opportunities is as fulsome as ever. So we'll continue to focus in that space. It's always been a core pillar within our strategic lens going forward. So, we'll continue to have a look at opportunities as they come to the fore. But pleasingly, core debt's now paid down, and all of our seasonal facilities essentially against net working capital and Australian crop.
Well, one of the areas that you are upgrading is the Leeton plant. What sort of spend is being booked at for that, and what are the return expectations for the business from that spend?
Right, the business is looking to spend about $20 million in our Leeton upgrade facility. So that's essentially our packing hall and fumigation silos, as we look to automate that and really bring some best-in-class technology into the packing hall of the rice mill in that part of the world in our portfolio. And in terms of, we're looking to bring that online probably FY26. So the next 12 months we'll be, looking to install and finalize testing and ultimately look to commission that at least 12 months down the track. Now, the way that will work is because it's really going to support the rice side of the business in the Australian paddy. It will mean that our asset base will increase to the tune of the 20 million, and we will then apply the asset finance charge, which will show up as an income in the corporate segment. So I can turn your minds to the asset finance charge, and that's where you'll see the income side of that CapEx spend come into the business to the profit side. Within the paddy price, we hope to gain some efficiencies from those operational improvements, which will ideally offset the likes of depreciation and the interest spend that the paddy price will have to absorb on that side of the ledger.
And the cessation of the New South Wales vesting arrangements in July 2025 appears to have been taken positively by SunRice. Can you take us through the reasons why?
As a business, we're certainly looking forward to the reduced regulatory environment. At the moment, we are the buyer of last resort. So whatever gets grown in the Riverina, we're obliged to purchase. So without that in place, it really enables us to match supply and demand going forward, and working very closely with our growers to ensure that we can really plan ahead with the amount of supply that we need from them, and in doing so, position that Aussie rice into higher returning markets and generate a healthy paddy return for our growers, but then equally give the international side of our business that opportunity to continue to source rice for our global markets. And therefore, we'll be able to manage that balance a lot better, as opposed to whatever gets grown, we have to buy and find markets for that, which has been the case in the past with vesting. So the next 12 months will be a transition period as we navigate our way through what life after vesting will look like. But we're certainly feeling positive in terms of being able to manage the supply and the demand antics of the business in the future.
Well, thank you, Dimitri, for taking the time to speak with me today. I'm looking forward to catching up with you over the course of the next 12 months to check on SunRice's progress.
Thank you, Finola.